Hello, everyone. After my post on, bull put spread and bull call spread, right? Long call vertical spread and short put vertical spread comparisons. I got a lot of questions regarding what is short put spread, how it works, and what I'm doing to earn income every month using that short put vertical strategy, right? So that's option strategy that typically people use to generate monthly or weekly or quarterly income uh, by placing that trades, right? Uh, you know, um, what I do is that I most of my spread is actually seriously short put spread, right? Short put spread in the sense that I use short put spread to generate an income in a market that is going upwards, right? Which is a bullish market, right? So if the market is bullish, if the stock is bullish, if the sector is bullish, then I place a trade and I try to earn some income, right? But um, so how that works and what are the kind of principles that I follow, what are kind of rules that I follow while placing the trade, so that I have more chance of making money and not losing, right? One thing about short put spread is that you can make money, but if you lose, you lose bigger. You always your income, risk versus reward. Your reward would be like one third or max two third or sometimes even less than one third than the risk, right? So what I'd be doing to minimize my risk at the same time earn enough income so that the trade makes sense, the time and effort that you are spending makes sense, and you can maximize your income over the months and years and all, whatnot, right? Okay, so this is the income strategy, right? So basically, let me go to think and swim and see if I can pull up something that I can share with you guys as a um, kind of my thought process, right? Okay, so so this is short put spread, right? We are doing short put spread in this call. This is an income strategy for with option and what is the income strategy? Like, you want to earn money at a consistent basis, whether you are doing a monthly spreads or weekly spreads or even bigger longer period spreads. You want to generate a consistent income making those spreads. So that is the income strategy. There are other strategy, like the other investment strategy, like long term investment strategy, where people just go and buy the stock or buy a long call to buy the stock in case price goes down and whatnot, or something like that, right? But this is the income strategy. This is like make money and forget, right? That's why I written income strategy. The rules that I kind of follow, right? So the rule number one is that market is uptrending, right? So the market should be uptrending. And second is that the sector for which the stock that I'm trying to place the trade, if I have something in my mind, has to be uptrending too, has to be uptrending. So they are should be a bullish market. The market is not a bear market; it's a bull market. The market is going up. The sector is doing good. Not all sector will be doing good in a bull market. There will be some sector that is not going to do good, right? So many of the time, when tech is rising, and then you will see that maybe the healthcare is not doing good, maybe the consumer staples is not doing good. When consumer staples is doing good, maybe healthcare is doing good, but not the other way, right? So all these things has to be seen into the context, and the stock, that particular stock that you are placing trade for short put vertical, it has to be also uptrending, right? Uptrending. Now, you know it has to be uptrending, because sometimes you'll hear that short put vertical, the stock doesn't have to go up, or stock can go down little. Yes, those are truth, but the thing is that it has to be an uptrend over a period of time, right? So for example, I mean, if I look at these rules that I follow in my own in today's time, like, so if I do S&P 500 index, right? So if I not use this chart, but some other chart, let's say, uh, yeah, so this chart for SPX, which is S&P 500. It tracks 500 top companies in United States, those high quality companies. And what do we see in the chart? I mean, we see that this is an uptrending bull market, right? So if you see the trend from here to here, right? So it is an uptrending market. So stock is going up, going up, going up. Last few days it made some drop, but it's still an uptrend. It's a huge uptrend, right? You see that I have a 10-day moving average. You have seen my 30-day moving average. Stock is still kind of today it broke down to 10-day moving average, but it's still above 30-day moving average. So as long as this moving average stock is above that and it's not falling hard, like what happened here, I would say that is stock is in the market is in bullish market, right? And then if you see particular sector, I'd say for technology sector, I mean, you can always see that, here you can see the XLK, which is tracks only the tech sectors of S&P 500 companies, maybe 120 companies are there, or maybe less, I don't know. But this is the, yeah, this tracks the technology sector of S&P 500. And we see that, we see the same thing. We see a huge uptrend here also, right? Today is touching 10-day moving average. It's actually went up, so it's still green. And after 2 days of red, market is trying to recover and bouncing off the 10-day moving average. So over a period of time, from April, that tariff fiasco, we see that it's in uptrend, right? So we saw the market is uptrending, we saw the sector is uptrending, and now let's say I'm focusing on Nvidia, right? So what happened with Nvidia? Let's see that. This is the stock I want to place a trade, right? So I see it's the same thing. I see a huge uptrend going on, and there are some, kind of like a consolidations drop here, going up and down a little bit here, but it's still over a period of time is uptrending, and it might continue that uptrend, right? So this is the stock then I'll choose to even think about, placing a short put vertical spread to earn any money, because I know that stock is trying to go up, keep the momentum upwards. The sector is good, the market is good, all looks pretty bullish to me. So now I can really think of placing a trade. Now that doesn't mean that I'm going to place the trade, but I have some other things to look at, right? So uh, about short put spread is like, you are making some money by placing a higher price short put and a lower strike long put, right? So what you are saying is that, and let me give an example. Let's take Nvidia as an example and go to the trade section and see, okay, you know what? I don't need this, can get rid of it. I don't need that either. And let's say, I'm looking at a couple of things, right? So now that I want to place, I'm intending to place a trade on Nvidia. I would see like, okay, what is my expiry date, right? What is the how long I want this trade to be alive, right? So typically the rule that I follow is like, maybe 30 to 45 days, sometime 22 to 20 to 45 days, depends on what's going on, right? Earning and all those things. So that is kind of like a range of days to expire for the trade, right? So that the stock has enough time to go up, or stay where it is, at least not go down. If it goes down in a week or two, at least it has time to recover, and at least I have time to adjust if I have done something wrong, like for example chose a wrong strike, or stock is going down because of some market news or whatever happens to the company. I have time to react, not just it's not zero DTE, or something like finishing in a week and I don't have time to adjust. It's like loss is already been written in stone, right? So I would like to get some time, right? So 20 to 45 days, and this is like many of the expert traders over their experience, and there are many trades, the million trades that people are placing. That's kind of like a ballpark range that I've seen everywhere, and I'm pretty confident that this is the range that I it works for me, right? So given the fact that today is like what, September 25th, right? So I'll go like, maybe sometime mid of October towards the third week of October, something like that. So let's say I choose like, let's choose 31st October. It's the end of month, this month close and all those things. So let's see what happens, right? So once I go there, once I like, okay, NVIDIA is a stock, market is, NVIDIA is a semiconductor, is a technical company, technology company, and it's like, market is up and all those things. I'm ready to place a trade. Now I want to earn some money on the put side, so I'm placing a trade, a short put and a long put, right? The short put is what you are selling, and the long put, what you are buying. So short put, short put is selling, uh, by selling a put at a higher strike, and long put of the arm of the spread, right? So our spread has two arm, right? This is the vertical spread has two arm, and so buying a put at a lower strike, right? So that's what we're going to do. But here is the thing, like to understand what a short put means. Short put means selling a put means what I'm doing is that I'm getting into an obligation to buy the stock at that strike price. So by the expiry date, if stock price, the market price of the stock is less than the short put strike, then I'm obligated to buy that stock at the strike price, right? So if I say, let's say NVIDIA, I place a trade or at like 170, right? And in October 31st, I see the NVIDIA stock price is, market price is 165. So the brokerage firm that you'll be using, or I'm using, will for enforce buying the stock of Nvidia at $170 each, even though the market price is 165. So see, you have that obligations when you place a short put strike. But here is the good news, right? The spread has the protections, downside protections, which means is that you have a lower strike. Like stock could have gone like a zero, right? Nvidia can go to zero, like from 170, 180, whatever. Then that means you have unlimited loss, right? You have the whole stock price will be, stock money that you invested is like 100 stocks will be lost. So if it is 170 is a strike, that loss will be like 17,000 dollars. So to protect that, that's why you are putting spread, right? So you have a long put that also gives us the right to sell the stock at some price, right? So if I do a $5 wide spread, let me show you in the real examples here. Let's say I buy 170, right? I buy 170, and then I sell 160, let's say, right? So I sell um, 160, right? So you buy 170, you sell higher strike and buy lower strike. So yeah, so if you do that, you see that you have obligation to buy the stock at 170, if the stock price is less than 170, and but you also can sell the stock at 160. So basically, you're $10 wide spread, right? The width of the spread, this is called the width of the spread, which is higher strike minus the lower strike price, is also very crucial, right? So this is, comes into the picture of like risk management, right? Or risk tolerance, I would say. Risk tolerance. So how much money you are, ready to lose if the stock goes a different direction that you are thinking, right? So as I said at the beginning, the short put spread is a bullish spread, but stock can stay where it is right now. But in case it keep going down, you can lose money. So risk tolerance is the money that you can lose. So if the stock is below 170 and you are about to get assigned, you can close that, right? But if you see that, you'll probably get some pennies or whatever little amount of money by selling this 160, and you have to buy that 170 strike back. What doesn't mean is that, as long as you have this backup plan, and protection downside protections, you are not going to lose like $17,000 money. You lose some, but not that huge. But how much you'll be losing, right? So here you will see this trade has $2.48 credit. What does it mean? That as soon as you place the trade, you will get $248. So right, so um, your credit from the spread is 2.48, or you can say it is $248, right? So $248 you will get as soon as you place the trade. That is the max profit. So that is also the max profit that you can make, right? You won't make any penny more than this from this trade, no matter what happens to this NVIDIA price. NVIDIA price goes to moon, it doesn't matter. You make only $248 or whatever it is, right? But the loss side, right? So whatever your loss, so your loss or max loss, I would say in this sense, equal to the width of the spread. So width of the spread minus the credit you received, right? You credit what, which is then in this case is 10 minus 2.48 equal to 7.52, right? So that is the dollar that is at stake. So this is, or I can say like this is actually dollar 752. So this is also max loss. This is the money maximum you can lose from this trade, right? And you need to make sure that your risk tolerance is at least okay to lose dollar 750 if this stock goes, in different direction that you are already thinking, right? So this is uh, you know about the short put spread. But I just want to highlight, right? Then how? Okay, I have a $248 profit chance of making that money, $752 chance of making loss. That is my risk. There is a risk and reward. Now let's say if I do a risk and reward calculation. So let's see. So I can make $2.48 divided by 7.52. That is 30, 32%, 30, almost like 33%, right? So I would say my risk reward equal to 33%, right? 33%. So that is not bad. I mean, this is kind of like the rule that I follow, that at least there is 30% risk reward, right? So you make 30 cent for each dollar you are taking risk, right? That is the kind of like a ballpark. Not always I have to follow, or not that everybody has to follow. If you can make more, if it is 50%, why not, right? But there is you can make more profit, but your probability can go down, right? So that those are the things that you have to see, that if you are successful, yeah, you make more money, but how, what is the chance of you making that money or being successful goes down. So there is always like that trade-off, right? So here we can see this trade. If you see confirm and send, you can see all these things. So $752 loss, chance of max loss, chance of max profit $248, all these things, right? So now that's okay, but how to choose this strike, right? I talked about like choosing the expiry date, which is 20 to 45 days. But for choosing the strike, I do is that I followed, most of the time I follow two things. One is the delta, which is an option Greek, and the delta needs its own sessions. Is a robust topic to discuss. It's very important for option trades, and definitely for vertical spreads, but also like for any option trades. But for time being, I'm saying that delta is the change of the option price by the change of underlying stock of $1, right? So if Nvidia moves up and down $1, what is that option price will change? Right now you see that these are the bid and ask of the option price. And so, and there is this strike of Nvidia, and there is this current price of Nvidia. So if Nvidia goes 177.69 to tomorrow $178 to 69 cents, $1 more, this price will change, right? This price is constantly changing by the change in the stock price, because in the market open, stock price is changing, this option price is changing. So as this Nvidia underlying stock price is moving up and down, the change is happening in the underlying option prices of any strike of any expiry date. That's is determined by delta. So delta is option Greek calculates the rate of change of the option price based on the change in the underlying stock price change, right? Think of like this, if I increase my speed of driving an mile per hour, more or less, how fast and slow I can reach to my destination, right? So that is delta in mathematical terms is the first derivative of like option price by the stock price and all those things. This is not a calculus session, so I'm not getting into that. So delta is the most important, right? So how I use delta, right? So I have like rules set, right? So I don't trade anything above 30 delta for my short put, the put that I'm selling. So here in this example, I was selling like, what is that example? I was like 170, something like that. But in reality, like, if you go here and choose like, okay, delta comma theta, and you will see the deltas here, you'll see that 170 is like 33 delta, right? So I would go a little less. I typically will choose, okay, you know what, maybe 25, right? Maybe if I would have been since 30 here, maybe I'd chosen, but no, I'll choose 25. I'll choose even below, right? How much confident I'm feeling about Nvidia not going down to this price, right? That's what it is, right? And at the same time, another significance, a derived significance of delta is the lower the delta is, the higher the probability that the stock would not cross and go down, right? So for example, if the delta is 20 25 here, which is like 25 means almost like 75% chance that the Nvidia price won't go down below 165 by this date of October 31st, right? That's what another interpretations are, use of delta, right? So that is why I'm using, because to see the probability, volatility, and all those things. I mean, there is other flags, right? The gamma is also the second derivative of the option price. Theta manages the time decay and all those things, and vega. But here I'm looking at delta. And more importantly, I look at the delta, right? And the delta, let's say, I choose delta that is less than 20, which is I have more than 80% chance of winning the trade. So means that Nvidia stock will be above 160, and I won't get assigned. I don't have to think about not making the profit. So in this case, the short put, which is the put that I'm selling, I'll choose 160, and I'll then go like with my risk tolerance. Yes, I can, take a $10 hit. So I'll choose, let's say, 150. Someone can choose 155 if they want. I mean, if you don't want to really risk more money, you can do 155, right? So let's look at the 155 first, right? So you see that what is changing? The changing is the income that I'm making, the credit, right? If I'm successful on this trade by October 31st, stock remains above 160, I'll make 73 cent. But if I would have taken a little more risk and go like $10 wide, right, I would make $1.25, right? So that's where the magic is, right? So typically I have a set of mind that how much money I'm going to risk at this, and how much money making is worth my time. So I typically don't go below 50 cent or $50 for the income. So not it doesn't make my time worth, or the risk that I'm taking worth. So follow at least um, $50 income. If more, that's great. And no more than, let's say, um, $700 at a risk, right? $7 risk, right? So that is kind of, and this is like nobody can really tell you what to do, is really up to you. But you see the balance of trades, the more income, the more risk, more lower probability of winning the trade, and more money could be at the risk, and lower the income, is higher probability of winning this, making money, however low it is, and lower money at the risk, right? So if someone wants $124, they will choose $10. If someone is happy with less to income, but not put a lot of money in the risks, that $73, and there's only like so this is a $5 right, $5 minus 73, so it would be $4.27 at risk, right? So if you can see that here, $4.27, $427, and this is the maximum profit, which is $73. um yeah, I mean, this is pretty much. So it's a play of delta. It's play of choosing the right expiry date, and choosing the right width of the spread, once you settle down on the short side of the put. So another thing I want to say, that short put vertical things are critical is this short put. So you want the stock above this, right? So this is where the delta focus would be there. Focus on the delta on this, and then the long put will be based on how much money that you want to put at a risk, right? A $10 wide, $20 wide, $5 wide. You can do a lot less than that. We can maybe do 156. There is a $4 at risk, all those things, right? So uh, this is the play, right? This is kind of a rule I follow. So my rules are like, the expiry date I choose. So as from the start, right, the market has to be uptrending, the sector has to be uptrending, the stock has to be uptrending. There is to be enough date in the expiry I choose. I don't typically do shorter period spreads. I could, I did, I've done, I am doing, but not typical for me to do it. 20 to 45 days. Typically, mostly it's 45 days, and then I try to see if I can close in 20 days or not. Those details, there are more details involved into that, and a little bit advanced discussion on those things that I will do in the next videos. But here, and then selling a put strike with the right delta below 30. So the rule would be like, okay, the delta below at least 30. So my probability probability of winning the trade is at least 70, right? I don't go below that, hardly ever, right? Unless there is always an exceptional case, winning, earning play and all those things. But this is kind of like a more of the kind of like a standards that I follow, the rule that I set for myself, and I try to stick to that, right? uh, Okay, so that is about it right now. So this is the trade. This is low, high probability, and if you can use think and swim. Another thing that I want to show you, that if you right click on this trade anywhere in the trade, and this click the analyst trade button, you can go here and you can see that what are the risk profiles. So you see that as long as the Nvidia stock by October 31st is above 159.83 cent, you are making profit. Your max profit is $73. Your max loss is 400, $23 or something like that, right? So this is a graph that will show the probability, right? Okay, how much probability you have. Like you can change something here. You can set that slice to break even to number one after the day of expiry. And you can see that you have a very good 76.5% probability to winning this trade, which is good. Anything above 75% is good. I said 70, maybe 75%, 76% is better. So you're making a little less money, but you have more chance making that money than losing, right? So with that, I'll conclude my session today. Thank you very much. Bye-bye.